If people believe there's going to be a recession, then they buckle down and they save money and they'll be more conservative with their spending.
I don't need more chaos in my life at the moment, so I'm sorry for not being able to say anything more coherent than when you hire clowns, expect the circus kind of thing.
A lot of the stocks I'm invested in seem to be objectively overvalued.
There is no such thing as like a kind of correct price for something, if that makes sense. Price is a construct.
I tried to avoid biotech because I just don't really understand it.
If AI is as good as it seems like it's going to be,
I just tend to try and buy quality companies and hold them for a long time. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hey, and welcome to the latest Wall Street Wildlife with Krzysztof and Luke. On today's episode, when are tariffs going to hit the US consumer and what's the world going to feel like? BlackRock makes the case for increased democratization of investing. Krzysztof's going to tell us what that means. Plus, how US investors can increase their exposure to Europe. And I make my first buy trade since January. At the back of the episode, I'll tell you what I bought and why.
Goodness, that's exciting. How's your weekend, Badger?
Pretty good. You know, I got a special consignment of a final piece of Patreon merch. I got my Wall Street Wildlife t-shirt.
I knew there was, I sensed there was something extra shiny and debonair about you this morning.
Got all the merchandise now. Katrina even said that's a nice t-shirt, and it was actually quite a nice fitted t-shirt. So I might try and find whoever manufactures the actual t-shirts and get myself a few extras.
Oh, sweet. Oh, I can't wait to get my paws on one of those buttes. Everyone listening out there in YouTube land or Spotify land, we're at Wall Street Wildlife. I'm sorry, patreon.com/Wall Street Wildlife, where you could join one of our tiers to get your hands on this really stunning fashion statement. I'm glad you're bringing some light and joy into our conversation. I had another really rough weekend, Badger. My other furry buddy left us this weekend, Daisy. And so I'm still in the immense throes of grief. And, it's just such a heavy hole in the heart. And this is now I lost two buddies and a close friend in 6 months. So this whole death thing, man, it's what we get when we're born, I suppose.
The universe is throwing some heavy shit at you. Sorry to hear that.
Man, goodness gracious. So anyway, it's lovely to see you because, in moments of intense loss, it's, I suppose you could, despair and fight reality, or you could be grateful for what's here and what we have. And I'm immensely grateful to be doing this with you.
I'll be your friend.
And especially now that you're looking so stunningly handsome.
I was reflecting on sushi's mortality the other day. So at the weekend, I don't want to go into too big of a sidebar, but I did. Katrina and I did 23andMe years ago. I think I may have said in a recent episode, like we found I found a second cousin. So essentially like a whole branch of the family, neither of us knew existed because of the somewhat scurrilous nature of my great-grandfather. So we went to meet them at the weekend. And so that was fabulous. My mum and my aunt to meet their new first cousins. So like pretty close relations to them. Unfortunately, they've got like a doggy who's definitely on his last legs. Bailey, the dog. So, but Bailey's 2 years younger than Sushi, my cat. So I came back. I know cats last a bit longer than dogs, but Sushi's looking pretty like healthy and handsome still, but might be near the end of the road for our furry friend at some point too.
Well, that's the thing. The decline was so quick, but we knew it was the right thing to do. One of my last moments with Daisy, where I was just holding her and her little, I could feel the breath she was taking, as she was inhaling and exhaling on my arm, and it's just such a extraordinarily tender tender moment and precious, this life, and it goes by so fast. So all y'all listen to us. Sorry to be beating the same drum repeatedly, it seems like, but it does go by fast and you never know. So investing is for living, or living, more fully. It's one of the things that enables us to get more out of
Well,
life.
hopefully we don't need to remind ourselves of that again this year. Let's hope.
I know. Because, I'm running out of, well, I hope it's not one of us. I hope you don't get some bad news about your humble monkey, your humble pound monkey anytime soon. But I definitely,
You got to stay alive because I think we might be getting together at some point in Europe a bit later this year, like more to be announced. But don't die before then because I fancy my little vacation to come visit you.
yeah, I'd be way less fun
Yeah.
dead.
Plus, I mean, if I have to come to your funeral in Austin, like I am actually, we'll come back onto this topic a bit later about how Americans can get exposure to European stocks. Like, what's going on with the US border? Like, I'm seeing horror stories all over Reddit about like both Europeans who are there legally and American citizens like having a whole bunch of trouble when they come back into the States and being like put in detention. Like I'm supposed to be coming out for the US Open to visit a couple of close friends. And even I'm thinking, like, is that the right thing to do right now?
It's a
Yeah.
mess. It's a complete mess. Man, I really, because of this heavy heart I had all weekend long, when uh, when bad news was showing up in the news feed and all the big headlines, I did not look, because I don't need more chaos in my life at the moment. So I'm sorry for not being able to say anything more coherent than when you hire clowns, expect the circus kind of thing.
Fair enough.
I do know, the one thing I'll say is that on the university level, there's many students being deported, many students, graduate students, not being let in, and many students don't know, what to expect or how to deal with any of this. So it is major chaos,
Mm.
and it's, you know I pride myself for trying to stay as, call it, curious amidst the complexities. But the more I see outright violations of law and certain freedoms, the more it seems shameful not to say something, you know, openly about fundamental violations. But I let this not be the episode. I'm not ready to go ranting just yet.
Yeah, fair enough. Fair enough. Well, let's turn to some investing news. And before we get into our headline topics for today, it is earnings season. And this is going to be a particularly interesting earnings season. Like we're recording on the 21st of April, and Tesla report tomorrow, as do a couple of other stocks in my portfolio, Intuitive Surgical, and I think Lockheed Martin. So I'm going to be pretty busy over the next couple of days on my running, listening to earnings calls and takes. I don't want to make any predictions about Tesla because they're going to age so quickly, but I think we can probably be assured it's going to be a volatile moment for the company right now.
I'll make a prediction.
Go for it.
It's going to be bad.
Yeah. Okay. But I mean, so bad results. Like, okay. So what do we know?
Yeah.
Yeah. Like deliveries are going to be down, but I think the market's already priced in like a bunch of that. Probably like the thing that really drives the market, or certainly for growth stocks and stocks like Tesla, are forecasts. What does the company say about their future planned expected deliveries? So that's really going to be like the headline news tomorrow. We don't know what Musk and his team are going to say about that, but I imagine it's going to be ugly. Like Tesla, despite the fact that Musk is in bed with Trump, Tesla get hurt by tariffs. Plus, you've got all the anti-Tesla sentiment we talked about on a recent pod.
I don't think the market is pricing in a report that could be way worse than even anticipated. And uh, for me right now, Tesla is, I've said this so many times, it's not what they're doing now, it's what they're going to be
Yeah.
doing. that's most investable. And what they're going to be doing is not happening now, and it's not going to happen next quarter. So on this call, I'm guessing Elon's going to give us, his rah-rah pep talk about how it's going to be the world's most valuable company with the robots and with the auto taxis. But I think the market's probably not going to buy that. It's not going to be enough to compensate what will probably be even worse results than anyone could anticipate, because the outcry, it was this quarter, right? It was the previous 3 months that had he had the most, call it, political damage, caused the most political damage in terms of people actually destroying Teslas on the street and buying stickers saying, I want no part of I bought this car before Elon was crazy, and all this kind of stuff. So in the sense that the market is a short-term, what's it called? Weighing machine?
Voting
No,
machine.
what's that?
The quote is, in the
Yeah,
short term, the market's a voting machine. In the long term, it's a weighing machine. Yeah.
yeah. So I'm using that adage as the vote's going to be bad.
Right.
My prediction, I'll for the fun of it, for shits and giggles, I'm gonna say the stock drops something like another 10%. And by the way, it's down 7% as we're recording now. So I'm sensing it's kind of anticipating something along the lines of what I'm talking about. But I wouldn't be surprised to see it drop below $200 per share.
Okay. Yeah. It's like $225 pretty much at the moment of recording. Wow. Okay. Sub $200. Do you own any Tesla right now?
I sold, yes, I have some, but I sold about 50%
Right.
some weeks ago.
Some weeks ago.
In
Right.
Yeah, 2 or 3 weeks ago. It's entirely in anticipation of, it's more market timing kind of tomfoolery. But I want to buy more shares back cheaper. And it's going to be what, in my mind, like at about a year till maybe the robo taxi stuff starts showing up. It certainly won't be in June. I mean, he says June for Austin, right? And maybe that'll be a little PR rah
Yeah.
rah, but it certainly won't be material for any company level wide income. So I'm hoping I have another year or so to buy back cheaper.
Yeah. Fair enough.
And by the way, I have a small allocation in King of the
Yeah.
Jungle, which I haven't touched for a while.
Yeah. I'm like 4.5%, maybe 4.2% Tesla in my real money portfolio. And I haven't touched it since September. It looks like I last sold Tesla in 2021, and then I've added to it in mid 2023 and late 2024. And that most recent buy was looking good, but now I'm slightly below that cost. So I've lost a little bit of money on that most recent ad. And I don't know, I'm not touching it. I kind of agree with you. Like, we're probably going to see more bad before we see good. It is still overvalued. For the last couple of episodes, I've been ranting about the fact that the market's taken a hit, but a lot of the stocks I'm invested in seem to be objectively overvalued, and Tesla's one of those. Even if it like drops down 10% tomorrow to sub $200, it's still probably overvalued. But it's such a hard company to value because there's all these essentially intangible future things that you're kind of pinning the thesis on, like robotaxi.
Yeah, agree. So we don't advocate for this very often on the show, kind of dipping in, dipping out. But this is one of these moments that I don't know if it feels like it feels, I'm emphasizing feels, like the probabilities are in my favor by doing a little bit of
Yeah,
short-termism,
fair enough.
because the news is kind of so obvious. And the market in the short term does react emotionally.
Yeah.
So
That's fair. I suppose maybe I did all this before. So I feel like I did all my selling up until like January time. And now I'm just waiting for valuations to get a bit more sensible. And I talked about a couple of stocks I'd set limit buy orders on last week. And I'm going to execute a buy, well, when markets open in Europe tomorrow. So I'll talk about that at the back of the episode. But essentially, I'm still kind of sitting on my hands apart from that one.
okay, you want to tell us about Intuitive Surgical as your largest position? Anything you're looking for?
No, like medtech tends to be a bit more resilient, and it's probably going to be more resilient to like tariffs because like demand for medical procedures, like it's essentially Intuitive Surgical, robotic surgery manufacturer. They sell these robotic surgeons called Da Vinci to hospitals all over the world. But it's kind of a razor and blades. I kind of jokingly used to say like robots and blades business model. Like they make most of their money from um, the consumables, that the actual device, like the kind of the thing at the end of the robotic arm, the instruments for like cutting and sewing and slicing and doing different things, suturing. Like they make the money by supplying those, and you can use those for like 2 or 3 procedures, but then you have to throw them out. And like that's not really going to be impacted by like tariffs. They do a lot of their manufacturing domestically, and it's also not like the demand isn't going to be impacted, especially because most of the procedures are like non-elective. Obviously there's some like cosmetic surgery and things like that you might put off if you're feeling a bit broke, but if you've got medical insurance, like you and you need to get something done, you're probably going to get it done. And if it's like a chronic condition, like you're going to get it done no matter what. So anyway, like medtech tends to be a bit more resilient and stable. It's a big position in my portfolio, like 15%, I think. I said it's the one I'm never selling unless it gets above 20% allocation.
Yeah, and I won't go on and on about this, but in general, I'm really looking for more investments in the biotech sector because it's been so badly beaten down. In fact, Transmedics is interestingly one of the strongest performers in recent
Mm.
weeks. As another example of, when life's on the line, it's kind of its own thing as long as it doesn't get disrupted. And obviously, Intuitive Surgical seems like it's in pole position. You're not worried about some new up and comer,
Oh,
correct?
definitely not. Yeah, like there's no real material competition. And like you said, biotech there, but like Transmedics and
Mm.
Intuitive Surgical, they're more like medical technology. Like if you imagine like the Venn diagram, like the big bubble in my mind is like medical technology, and then within that you've got like biotech and actually like devices and I know like services and different. There's like different subsets. I tried to avoid biotech because I just don't really understand it, and it's like it's just highly volatile, highly speculative kind of investing. But I do like my medical device companies, and I've bought Transmedics twice, and it's on my list of things I would like to add to. I'm just kind of holding off right now, but yeah, that looks like it's performing pretty well in the last couple of weeks. And I don't know if you read Jonah Lupton on X, pretty prolific like FinTwit chap. He's actually doing some quite decent due diligence where he's tracking Transmedics flights because you've got like flight data is public data, and he's using that
Mhm.
to try and get almost like a real time insight into their demand. And I think I won't try and pull out any specific tweets, but I think he's quite bullish on them as a consequence of the data he's seeing.
Yeah, right on. Thanks for that clarification between biotech and medtech. It's an important one. I don't think biotech is speculative in the sense if you if you can speak biotech language and if you could do the work. It's speculative in most ways that average investors don't know what the hell they were talking about, and yeah, then it's like binary outcomes.
Yeah. Anyway, Christoph, should we let's closer to our headline topics. Christoph, I think you're going to teach me about a revolutionary philosopher and what he has to say about investing.
Yeah. Well, he actually had nothing to say about investing, but I'm gonna bring it. I'm gonna tie it in. This is so pop quiz for you, Badger. Copernicus. Wow.
Yeah, I'm like
You
persecuted by the
remember
church. He
was
was like the world is not the center of the universe. That dude.
yeah. But this is worth going
Okay.
slow
Right.
around. Think about that for the history of humanity. We look out in the heavens, and the sun is the center, right? I'm sorry, the Earth is the center,
Right.
right? And the sun goes around us. But lo and behold, it's exactly the other way around,
Yeah.
right? Uh, Imagine just how mind blowing it is to discover for real that the way you thought the world was exactly opposite, and then to have to adjust everything around that revolution,
Yeah.
right? Well, in the philosophical world, one of the giants is Emmanuel Kant. And sometime around the late 1800s, I'm sorry, 18th century, so late 1700s, he wrote something called Critique of Pure Reason. And this brought about what's in philosophy commonly called the another Copernican level revolution. Here's what it is. It feels to us like we go around, we live in the world, and the world is out there. And what our mind does is it kind of conforms to the world. So we're like, we're learning about the world. Like that's what knowledge is. What Kant said is that it's exactly the opposite, that in fact, it's our minds that shape the world. There is no direct access to something called the world out there. We cannot, if you think about what seeing is, you're seeing and our perceptions are the thing that, the filters, if you will, or glasses, right? We can't not have our own glasses. So it's kind of like objects appear the way they do because of how our mind organizes them. And one of the tools we have at our disposal, I'm not going to get too kind of way out there, but things like the physicists now say, space and time and causality are not out there. They're what our mind does to make sense of relationships. So we create, in essence, time and space and causality. So, if you really sit with this, it's or if you really try to feel what that means, it can really be disoriented potentially, or like or maybe it's too hard to even feel that time doesn't really exist, space doesn't really exist. It's just a filter. It's just like a label we use.
Well, the White House is on your side, right? They infamously published like a letter or something last week saying our technologies can control time and space, and they got widely ridiculed for like that weird one-liner.
Yeah, right. So what does this have to do with investing? Well, I think a lot, because usually we sort of in a basic way, that the pre-revolutionary way of looking at things is like there's the markets and there's things like prices, and all these things kind of exist and we're just trying to measure them, right? Come up with better measurements. But I think it's more useful, if you take this stuff seriously, to realize that the way anything means anything is through our mental models of them. That it's all like a kind of filter. And so instead of trying to come up with like reacting to things like price, we would be better served to understand more deeply the mental models we're using to value things. Because there is no such thing as like a kind of correct price for something, if that makes sense. Price is a construct. This is the whole thing about, it kind of gets out there pretty soon, but the takeaway sort of slogan I came up with is this notion of, am I really seeing risk as though it's already out there, or am I constructing risk? And in this time of volatility, I think that that's an important shift in realization that we'd like to think of the world as independent of us and more stable, and we just have to get better measuring sticks. But all of this is pointing back to us, that we're the creators of markets, we're the creators of models, we're the creators of volatility, we're the creators of risk, right? It's on us to basically understand ourselves better. It's what we talk about all the time on our show.
Sure.
But, to kind of, for me to frame it as, there's philosophy before this idea in 17 called 90, and philosophy after it. And the world basically changed. Once people began understanding this, the whole place in the world really changed a lot. And I think we could become better investors, all of us, if we kind of sit with this a bit.
Like what you're saying resonates in some ways. Like, let's say a recession, right? That is almost like a self-fulfilling thing. And what people believe, if people believe there's going to be a recession, then they buckle down and they save money and they'll be more conservative with their spending. And that across like a whole society of people, if the net belief is this is going to happen, it's kind of self-fulfilling prophecy. So that there's that. But I think you're saying something deeper, which is like nothing really exists. It's like our perception of these things. And that, okay, that's a nice philosophical idea, but it's not actionable.
Yeah. Well, it is and it isn't. On one way, it is right. Sometimes after after doing something for a long time, it just becomes intuitive. But I think it helps us be less reactionary.
Okay.
I'm not saying that it's necessarily just perception. Everything's perception. I mean, there's part of it that's kind of sort of true, but it's more that everything is relational. And you're right that things become self-fulfilling, but we create the world. And if you're looking at all this risk and you kind of falsely assume that it's out there and you have to adjust to it, that's taking the stick from the wrong end. Look to the extent that you yourself are creating your own causes and conditions for feeling freaked out. And yeah, if enough people, I mean, it is at some point you do get to this. If enough people panic and go on bank runs, then the bank becomes bankrupt, right? Because they're projecting risk onto a system, and then that brings it to life. This is the kind of stuff, though, that I hope it's useful. It's useful for me anyway, as an investor, because it makes me feel more in control in one sense that no, it's not about like, no, I'm not in charge of the world, but I am in charge of the goggles or the glasses that I put on. And if I put on really freaked out, paranoid, scared goggles, that will be the way I interpret all the data that I see. And that's not going to make me wiser or make better decisions. So seeing my place in my contribution to the panic and whatnot helps me stay more grounded.
Should I be sort of reminded of the Matrix and like Neo in the waiting room for the Oracle, and there's like the Buddhist-looking kid, and he's like, "Simply realize there is no spoon." And then is that essentially that idea?
Close. It's just, I would say there is a spoon. It's just constructed in together with other you wouldn't even be able to use the word spoon if there wasn't somebody else to hear it.
Okay. All right. So let's take this now into like a totally different topic, but maybe we'll come back and revisit this idea after I give you some like really hard data and some thoughts around what's happening in the world right now. And then you can tell me if simply realize there are no tariffs. I don't know. Because these tariff impacts.
There are tariffs. There are
tariffs and they're hitting. So I got some data for you. Here is some data on week over week changes in ocean bookings from like last week of March to first week of April. And so this is essentially the change in like freight coming across from the rest of the world, moving globally. I think so. TEUs, just to kind of ground it, are 20-foot equivalent units, which is like almost like a container, like you might these big container ships. And so these declines in global imports and exports, these represent around 750,000 containers like reduction in global shipping. And you can see obviously like self-evidently the biggest decline is China into the US. So like there's a whole bunch of goods that would have been sailing and haven't arrived yet. And it takes a while for these impacts to kind of flow through the supply chain. I read an estimate that we're probably not going to see, because some of these supply chains are quite long and complex. Like you can imagine some of these containers will have like raw materials, which then get assembled and it builds like final goods in the US, and then those things end up on supermarket shelves or with retailers or business to business. So it could be as long as 12 months from like nowish before we really feel the impact, but we are gonna feel the impact of this decline in supply chains, and some things sooner than others. So and then what's going to happen if supply essentially starts to dry up? Well, the demand is still there, less supply, like economics 101, like prices are going to go up, and then that's going to drive inflation. So, and it's too late to make these changes, even if tariffs got reversed and put back to normal, like today. These ships are not sailing, and the lack of confidence from exporters and importers is such that like supply chains wouldn't be put back in place just because if the tariffs suddenly got turned off, they could get turned on again tomorrow. Like it's so unstable that it's sort of political decision making environment. Like I think most businesses, if they're smart, are just going to be like prudent and conservative and probably try and like de-risk their supply chains by getting like multiple suppliers, ideally domestic, but like some things you can't create domestically, like coffee, for example. So yeah, like the US consumers or the world's consumers haven't felt the impacts of this yet. It's going to come though. It's going to start, like price increases are probably going to start nowish in anticipation of these impacts, but we're not going to feel the full impact for up to a year. So there's some real data. What do you make of that? And then maybe you can try and apply your Kant philosophy to that as well.
I think Kant could go back to. I don't think we need him for this. Two questions for you. I remember during the early-ish stages of COVID when car prices became nuts. I was able to sell a used car for like way, way, way more than I could have, predicted. I was like, what the hell? Why?
Yeah.
Is it the same? Do you think a similar thing is going to happen? Like, put it this way: should I put my older Tesla Model 3 on the market? Should I sell it now or should I wait, let's say, like 6 months or a year? What do you think the price is going to go? The supply demand thing is going to increase the price of something like a Tesla because all these other imported cars will no longer be there?
That's complicated, right? Because Tesla is specifically complicated for a couple of reasons, and the car industry is specifically complicated. Like in North America, like most cars like majority of cars, like some are manufactured domestically. Most though have parts that come in internationally, and then you've got like all the cars from Germany, like Mercedes and the BMWs coming in, which are going to feel tariffs. You've got like Chinese cars or cars being manufactured in China. Like a lot of the Asian manufacturers, like the prices of them are going to go up significantly, but Tesla's facing its own unique challenges for all the reasons we talked about at the top of this episode. So, and I couldn't make a confident prediction, but if you were just to be really simple, yeah, the price of new cars will probably go up, like the price of all goods will probably go up, and that will necessarily, you would think, pull up the price of used goods if they have like economic value, like a used car is still a very valuable item. So yeah, in theory, the price of your used Tesla should rise because the price of a new Tesla is almost going to have to rise, or Tesla are going to have to sacrifice their own margins because of their own increased costs.
Yep. Now the other piece of this is, I mean, this is so reductive, but if part of this strategy is to increase U.S. based manufacturing and buy good old US of A instead of importer, then there are products, right, that won't be going up in price. All the products that are facing these tariffs. So I'm wondering, that's a US centric, I think, view because of how much we do bring in. Like coffee is a great example, counterexample. But to what extent someone like me who, I mean, I try to also pride myself on not buying too much other than books, or like not needing too much, like I try to live a minimalist-ish existence. What if I kind of reorganize my purchasing towards basics made in the US?
Yeah, I mean,
Is that
that's
too
what these policies are trying to encourage, right? Because they're creating this
right?
artificial increase in international goods, i.e., tariffs, so that ideally two things happen. Like American consumers, well, first of all, I suppose American businesses start manufacturing domestically, because that's, build and buy American. That's what all countries really want. They want like domestic consumption. But then, like, you should see a price difference, and that should encourage American consumers to consume domestically. But there are some things you can't, like coffee, for example. Like, you can't manufacture coffee in the US because you don't have the climate for it. Like, most coffee comes in from, I think, Vietnam and Brazil. Yeah,
Yeah. You know what I'm especially worried about, Badger? Price of bananas.
yeah, yeah. Is that the monkey? Yeah, yeah, totally. Yeah. Where do bananas come from?
I mean, how much, I can't, I could probably wean myself off of the coffee, but if all of a sudden I'm paying, $9 for a banana, that's a hard ask. Point being is I haven't seen the impacts yet. I know they're
Mhm.
coming, but I don't know if I'm being more like a sly fox in this moment and trying to think, well, one way of dealing with a tough situation is to readjust some mental frameworks. Maybe this is how we bring Kant back into this and say, okay, what assumptions am I bringing to this? That I have to have this and I have to have this and it has to come from here. But no, what if I reorganize my life so that I don't need this, this, and this? And I mean, I don't know. It's maybe wishful thinking. It seems like, there's that talk that Trump is engineering all this to drop the rates, to basically force the Fed to drop the rates so that businesses boom again. I think that's a possible outcome. Like once inflation kind of spikes very quickly, then the Fed is forced, and then we get back into the quantitative easing part of the cycle, and it might be like super bullish for the economy. I mean, I don't know. It's too complex to predict, but I'm not terrified yet. I'm not panicking. I don't,
Yeah, like, I suppose we're not, like, investors are somewhat unique because we look at the world in a bit of a different way, and we try and we think about the future in a slightly different way. Um, and if you're a more complex investor, probably more you than me, you can make money on the way up and the way down. I just tend to try and buy quality companies and hold them for a long time. What's my point here? So you're not panicking because you think you can reorganize your life around, like, the changing dynamics. And
and actually, to be completely transparent, because of my investing successes, I don't have to buy a new car. I don't have to deal with, say, higher mortgage rates. I don't have, like I'm not relying on gas. Like so. There's ways in which I think the people who have the least are unfortunately going to be most impacted.
yeah, but that could, if
So
that
I'm
goes really
seeing
badly, that could impact you, could impact all of us. Like, if, like, unfortunately, as you said, right, unfortunately, like, it's people who are already living kind of like paycheck to paycheck, essentially, or maybe they don't even have a paycheck, they're just living on welfare. They're going to suffer the most because the cost of their basic goods they need to survive in their life is going to go up in general. And so you can adjust your shopping basket to some extent, and continue to buy, like, less bananas but more, I don't know, oranges because they come from Florida or something. But there are some things you won't be able to change, that you just have to have, and and it's going to hit the poorest hardest. Like, you say you don't worry, and this is obviously an extreme view. This could end up with, like, literally, like, civil war, and God knows what, and like a massive, much bigger version of January the 6th that really kicks off, and then you might suddenly find you're under, like, armed, like curfews and stuff because everyone's like looting the streets because literally like some significant proportion of people cannot afford to live their life, and then like society falls apart. Right.
Right. That's the cycles. That's what we see in historic
Right.
cycles.
Yeah. I'm not saying that's going to happen. I don't believe that for a moment, but it's probably, I don't think you should panic, but also at the same time, you shouldn't be complacent. But that's not to say you should be like stockpiling like guns and digging like a bunker in your back garden, right? You can only worry about
Yeah,
small things.
and right, and for us investors, things like consumer staples, I suppose, are usually thought of as safe and steady sources of
Yeah.
income. I'm not sure if that's a good place to be looking at versus, if you look at our cumulative portfolios, we're tech heavy. I dabble in the biotech stuff, and I'm looking forward to things like energy and the AI
Hmm.
stuff because in this case, as we've said so many times, AI could be AI on the back of tech could be the sort of knight on knight with shining armor that kind of gets us out of this potential depression, but remains to be seen.
And at the same time, acknowledging that's like the AI optimist view, which you and I are, but the AI pessimist view is like what we're going through now, and potentially like people losing jobs and stuff, money being tight, and recession, maybe stagflation, maybe depression. That might be like nothing compared to when AI really comes, and like essentially everybody is out of a job. Um, so yeah,
Yeah,
like who knows?
yeah. And systems theory tells us things take longer to take effect than we usually give credit for. So there's always a delay. So yeah,
But being an investor is advantageous because if nothing else, it forces you, if you're good and you're actually doing your job, it forces you to think about the future and the impacts of some of these things. And you're essentially like doing that to manage your investment portfolio, but you're also learning like lessons about the world that you can apply to your own life. Like saying, oh, maybe I'll defer selling my used Tesla because I might be able to sell it a bit more, like at a higher price. Like BlackRock have something to say about this. Do you want to bring us on to your BlackRock topic for today?
yeah, I learned something. And I learned something, Badger, this weekend when I was reading Larry Fink, CEO of BlackRock's letter to investors. And he matters because he's kind of, I was saying to you, like a Warren Buffett figure because he's at the top of a company that has the most amount of assets under management in total. So, he controls markets in a sense, right? So when he talks, people listen because his his words and views have sway. What I learned, well, put it this way, his letter was quite optimistic, and it was kind of a rallying cry, and it's actually similar to what we say on the show repeatedly in terms of how investing as a way of life could really change a normal person's life. That if you actually integrate it into what you do and how you manage money, 20 years from now, your life will be, you'll have much more wealth than you would otherwise, right? So he's kind of rah rah into democratizing investing. What I learned, and this is kind of shocking that I didn't know this or know the extent of this, is he's saying that you probably know this, but the majority of the world's investing markets are private. And like it's kind of like what the hell, because I only deal with public markets myself. So to me, my view of it is like, oh, that's the majority of it. And every once in a while, you have some companies that, boy, I wish I could have invested in SpaceX or IKEA or Legos. Or I'm like, oh, that's too bad, right? But God, I have thousands to choose from. So, but the stat is that in the US, actually, guess how many in the US, what is the percentage of companies that are private
Yeah, well, I suppose you've given me a.
versus,
I would have guessed less than half because I was the same instinct as you. Even though I do some private investing, but obviously it's more than half because you said the majority. I don't know. I'd be cheating if I tried to guess because I thought it was low.
yeah, it's something like 81% are private.
Right.
And in the UK and in Europe, they're even higher than that. So his point is that the majority of the world's markets remain private and inaccessible to other investors. And he wants that to change. He basically wants to bring more access to private markets so that the whole world could benefit. His side thesis is that the usual way of financing growth and infrastructure is through governments and banks, right? And raising debt. But now we have so much debt that these old ways of doing things are kind of at their end. So we got to basically restructure and revitalize the entire financial system. He's also saying, and I think you'll agree with this, that we're on the cusp of immense investments in infrastructure, because we need not just roads and better, call it highways and all that, but data centers, for example, right? If the whole world is now going to live on AI, we need data centers. And one data center, you're talking like hundreds of billions of dollars. Like, these are major, major new investments. So where's the money going to come from? Well, apparently we have abundant amount of capital sitting on the sidelines. He names it at 25 trillion. So it's like just basically hanging out, not doing much of anything, not investing, just kind of like gaining tiny little bit of interest in some money market account, right? But 25 trillion. So he wants to basically democratize markets way beyond what they are, just allegedly, the levels they're sort of allegedly democratic. He's saying they're not really democratic at the moment, or not to the level they could be. And this really perked up my ears, because one of the fundamental pieces of his whole letter is that this fits right in line with the Chainlink thesis, is that he wants to see everything tokenized, equities, basically you could live in a world, according to his vision, in which you could buy and invest in pretty much anything. And if everything lives on chain as a token, the friction of buying and owning these things, the transparency of buying and owning these things goes way down, and things like fractional prices for anything becomes manageable. So, like, side example, Mercado Libre is $2,000 per share. Not every brokerage allows you to buy fractional shares, so many investors can't buy Mercado Libre, right? Let's say they only have $50, right? Same kind of idea. Like, you can't buy shares of a new airport that's about to be built. But what if you could, right? What if you could buy $100 worth of a new data center? Imagine a world where everything is literally on chain and tokenized, and whether the company is, it's basically a case for democratizing everything. And I'm excited for Chainlink specifically, because that's the infrastructure that would help make that happen. And it's
You're making a leap. You're making quite a big leap here. I know in your mind everything links back Chainlink. I think it's just like Chainlink's Oracle network is like plugged into your neurobiology, and everything it goes, it's Chainlink.
Well, I'm just reporting to you what Larry Fink's
Link.
Busted. I'm just reporting what this Grand Pruba of funds is saying. I connected it to Chainlink because that is the protocol that's going to allow all of that vision to happen. But he's clearly and publicly campaigning for this kind of reality to happen, and he's no small fish. That's kind of the takeaway point.
Okay,
I haven't read
the letter you're referring to. I would not be surprised that we think about his motivations, that he might be calling for increased access to private markets for US investors, because like in the UK, pretty much anybody can own like crowdfunding. Like, you can buy like £10 or £100 worth of a private market company that is listing their equity, and they're not on a stock market, but they might be raising money at like a few £1 million valuation. So they're still private, but you can own a piece of that. And you can't do that in the US. I think there's more stringent requirements around being an accredited investor, and it's easier in other parts of the world. So I can understand that he might be trying to promote that. It's a leap from that to like tokenizing everything, and like me being able to buy like a 1% share in your library behind you, right?
It is a leap. I mean, that's kind of the point. And it is interesting. Uh, See, this is okay. Let's bring back Kant again. It is fascinating that the world, it's all about its paradigms and paradigm shifts. And anytime a new paradigm is proposed, the first human reaction is to say that's insane or that's gobbledygook. It can't be because it's not the way it is. And it is a major stretch. What he's proposing is a major new revolution. It would be like living like our current way of doing things would be like the dark ages. But guess what? Like at some point, the history of the markets was that only wealthy people could invest their capital because there were no such things as stock markets, right? That's only that was invented something like 400 years ago, stock markets. And then in London there was more people had access, and at some point the gatekeepers came on board and say, no, keep all these peasants out of our markets because we want to have all the wealth. But good sense prevailed and was democratized, and another stock market floor opened. Then we had traders screaming at each other, right? And everything done slowly and mostly, but it is shifting. And so the main paradigm shift is, at this moment, only a tiny, tiny fraction of what could be investable is investable. And it's mostly reserved for the already wealthy. And there's a way now, we have the technology by which that could change. And this guy is trying to sort of make it happen way more quickly than it might otherwise. So, from my standpoint, based on the thesis that we teach, that if more people got involved, if there was less friction to get involved, if things were more fractional, and it was less of a divide between public and private, haves and have-nots, then I'm all for it. So it kind of resonated on that part. The execution remains to be seen.
Like knowing straddling both these worlds a little bit, although I'm predominantly like 90x% a public market investor. Like there are pros and cons to investing in the private market, and you're much more likely to like lose all your money, and it's certainly illiquid. Like we don't need to do like a whole lesson on that. So there are very good reasons why like it comes with a major health warning. And then at the same time, if you look at how, I know, let's go back to COVID, and then everyone got paid their like stimulus checks, and then a bunch of people made like a ton of money because they were essentially like gambling their stimmies in like the options market and buying like 0 day to expiry options on public market stocks. Like if you opened up private the access to private markets to everybody willy-nilly, like in some ways that's great because it democratizes that, and we do have that in the UK. But but there's also like a massive consequence as well, that like a bunch of people will lose their pants because they just won't understand the illiquidity and the complexity of investing in private assets. Like there is no market to go and sell your stock. So if you want to get your money out, even if the company's doing really well, like you can't release your money unless there's like a liquidity event, i.e. the stock goes public or it gets acquired or something happens. So there's a lot to be done. And it's not technology that prevents this stuff. It's like regulation, and you can debate whether the regulation is good or bad, helpful or not. But it isn't like it's not we waiting for something like Chainlink to come along to make it possible. Like you could do it today.
Yes, and I think my optimistic vision of finance living on blockchain solves, I think, some of these primary current problems
Yeah.
of speed and the middle. I call it this from our episode, the middleware problem. Where like if the technology just makes that all go
Sure.
away, then there's just more what's called lubricant for all these things to take place, and less money kind of filtering off into the gatekeepers, and that makes the whole system more than liquid because there's more reason to use it, and kind of flywheel that perpetuates
Yeah.
itself. uh, I'm excited. Look, I'm just saying I'm excited because there's a direction the world of finance is heading.
Yeah.
There's some big fish backing it. There's powerful technology that's enabling it to happen. And I say, I hope it happens because it'll be good for the world.
Yeah,
You
yeah,
know, let me cheer rah in one different way. If AI is as good as it seems like it's going to be, then the amount of investment that's going to be possible and needed is going to be like, levels higher than when everything was more analog. So the more capital that kind of gets involved, the better. And as long as we do it smartly, then, sure, there's going to be mistakes. Sure, there's going to be gamblers. Sure, there's going to be speculators that lose everything. But like, we don't close the casinos because we want to invest. So anyway, the world of investing might be getting even more open, and let's hope that happens.
yeah. Okay, yeah, okay. Fair enough. I buy that, and I do this today, so I'm in favor of it being available to everybody. So yeah.
Wall Street Wildlife is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Should we come on to another big topic for today, which is how US investors can increase their exposure to European markets?
Yeah, I need you to school me on this, given that I'm going to be getting in touch with my Polish and Italian roots more frequently than not. So,
Let's
US dollars.
Let's talk about that first of all, right? Because it was really fascinating. So I've got a bunch of North American buddies, and one of them popped up on WhatsApp just a couple of days ago and said, like, "Hey, Luke, can you help me think about my own portfolio?" And like he gets paid in dollars. He's a US citizen. He's like a US guy who travels a lot. So like he's one of my ski season buddies. And we did our season in France this year. So he's like spending euros and he travels a fair bit. And he's worried, frankly, that if the US dollar devalues too much, it might become really expensive to travel. And that is quite interesting if you've got, essentially like the man in the street. He is an investor. I'm deliberately not naming him. He is an investor, but in indexes and, sort of more like US centric kind of products. He's invested in the S&P and things like that. And he's got like his Roth and like a good retirement account in place. So he's relatively typical of like a typical working American who's like relatively wealthy. But he's starting to think about, shit, what if the US is fucked? Like, how do I kind of protect myself against this? And that is interesting that like US citizens are starting to ask themselves those questions.
Yeah. So I'm asking myself that question.
Yeah.
So what do I do?
Okay. So I got a bunch of answers for you. And I know you're going to come in at the back with your own suggestion. I'm going to let you make it, and we can have a laugh about it. But let me take you through a few things you can do. So the first thing is, let's say you want, just to simplify it, like European exposure, but you could apply the same arguments. I'll give some real examples. You can apply the same arguments to anyone who wants like UK or Latin America or Asia or China exposure, right? So the first thing is, if you want to insulate yourself against possibly the euro strengthening against the dollar longer term, the first thing is you can just own euros. So there's a bunch of ways you can do that. You could have like your bank might offer like a multi-currency account. You could literally just have like a euro account and buy euros and hold a euro balance, and then like the value of that will be more stable as your dollars kind of devalue. If you're going to do that, do definitely recommend checking out Wise, WISE. Like Wise allows you to have, I've got like a US balance and a euro balance and a sterling balance and a few other currencies as I need them. and you earn good interest on like 4 point something% on your euros if you have them invested with Wise. And I did a little bit of research to confirm, like is it FINRA? What's the name of the FDIC insurance. So it's like your money is protected when it's with a bank. Wise are not a bank, but you do get FDIC protection on your euros if Wise are holding them for you, because essentially it passes through, because Wise don't invest that money themselves. They invest it with a bunch of other reputable real banks that come under FDIC. So your money's kind of safe with Wise. Do your own due diligence if you've got a very large amount, and you could just hold.
So wait, Badger, can I pause you right there? So as far as practical suggestions, so right now I have a chunk of bananas living in my Wise account, but they're all USD. You're saying I should take something like, let's say, 25% and flip it over to euros for stability purpose, something
more
like
complex.
that?
Well, but okay, suppose if you know you are going to be spending euros this year because you've got like a relatively big trip to Italy and Poland coming up, then you might want to buy your euros now. It's a bit simplistic, but if you think the dollar is going to go down relative to the euro, then why not buy the currency you're going to need?
Okay. Though that is in a sense like a little bit like playing the market, right? It would be
this whole sort of segment is predicated on the fact, like, if you as an investor believe the dollar is going to get devalued, what are your tactics? So there's one tactic. Like, if you don't believe that, ignore this whole section, right? If you think the US dollar is going to be strong, like, skip forwards 10 minutes.
Well, so as a little bit of a, call it hedging strategy, why not? I just started with 25%, but why not then say do something like 10%? Just switch over just a little bit. And
sure, I mean, you're unlikely if you're, let's say, I mean, if we say we're talking about your retirement account or something, and it's maybe, I suppose this segment is not so much about I'm going to go on vacation and spend a couple of €1,000. This is more like, if I think the US is in serious trouble over the 5 to 10 year time frame, and maybe I might want to, maybe I live in North America and I have a vision about moving to Italy in 10 years time, or your ability to buy, let's say, buy property in Italy, that's like a 6-figure purchase, is going to get eroded if the dollar devalues. So you might want to do something more substantial than a couple of €1,000 in your Wise account, but that's like one of the things you can do. So then maybe let's come on to some of the other things you can do, because you could hold like, a couple of €100,000 in euro cash, and as long as it's FDIC protected and it's earning like a decent interest rate, that's going to give you like material insulation. But there's other things you can do as well. So the next thing you could do is, it's quite difficult for US retail investors, I think, but you could buy European government bonds. So like in the UK, we call them gilts. It's like essentially the UK version of a treasury, a T-bill. But you have the same thing, I think they're called bunds in Germany, and then like the same thing in France and Italy, Spain. All these companies have government bonds that they issue. You could buy government bonds. I think that's quite difficult, though, for a US retail investor to buy. But what a US retail investor can buy with most brokerages is a European corporate bond ETF or a European government bond ETF. So essentially you're buying like an ETF wrapped, like an exchange traded, like a stock. ETF is kind of like a stock. You're buying a stock that reflects the returns of the things that it holds. So you could buy ETFs that hold European government bonds. Now you want to make sure if you're doing this because you're trying to protect yourself from interest rate kind of falling apart on the USD, you need to buy an unhedged ETF. And to be fair, the majority of these ETFs are unhedged, but some. So let's say if you bought a hedged ETF, then there's like some financial shenanigans happen within that ETF that already kind of neutralize the currency impact. And you don't want that, because you want the currency impact, because in this particular scenario, like you're trying to sort of increase your euro exposure and decrease your US dollar exposure. So just make sure you're buying an unhedged international bond ETF. And I haven't done too much research on this, but some examples are the SPDR Bloomberg Short-Term International Treasury, also iShares 1 to 3 year International Treasury, ticker ISHG. So like buying one of those as a US investor would essentially give you exposure to international government bonds. Make sense?
Yeah, it makes sense mostly. The only remaining question I have for you, Badger, is my own sense of, say, the European Union's own economic strength is that it too is quite wobbly and unstable. That's a whole different issue than, say, the US dollar's value as the world's reserve currency and so forth. But is it possible that I can believe both, that one, the US dollar is in trouble, but also that the European Union isn't doing so hot either? Does that kind of end up like a sort of wash, or is it just, where in the end doing nothing is the right thing, or are they?
I think an investor needs to answer that for themselves. Like I'm trying to answer the question through someone who's specifically said, like, I think the US is going to go down, the US dollar is going to go down versus the euro. Like, what are my options to protect myself against that? So, like, if you think that, here's one of your options. Right. But you're right. Like, and if you bought, let's give like a health warning. If you bought, let's say, German government bonds, which were ETF wrapped, then you have like a whole different bunch of risks. Like, you want the currency risk because that's the reason you're buying it, because you want the exposure to the euro strengthening against the dollar. But you have like what if, some European country defaults on its debt? Like, it's incredibly unlikely, but it's not impossible. And then what you have, like, interest rate risk if you buy government bonds. And for complicated reasons, I think I recorded a special on this. We never actually got around to releasing. But essentially, if you buy, highly simplified, let's say you buy like a 10-year bond, essentially like a loan, and you're buying, something that pays you coupon payments every 6 months at a defined interest rate. And let's say that interest rate is, I'm making this up, like 4%, which is sort of broadly what you'd get on cash in the bank. Well, if interest rates go up because of inflation, perhaps, and your money in the bank suddenly starts earning 5%, well, the value of your bond still pays 4%. The value of your bond goes down in real terms because suddenly, no one wants it, because if you're putting new money in tomorrow, like, you'd stick the money in the bank, or you buy like the new issue of the bond that pays the higher rate. So what happens is the actual value of your bond goes down, and there's workarounds for that, where you have like shorter duration. You might, like, I own a combination of 6-month and 1-year gilts, which I hold to expiry. By the way, it's going a bit off the topic it's going a bit far outside the scope of this main topic. But if you want to hear about that, like, message us, and I'll definitely go into that a bit deeper. So let me carry on though, come back on track. You could hold cash, you can hold bond ETFs, which might be corporate bonds or they might be government bonds, but you also own stocks. And it doesn't mean you have to be an individual investor. Like, if you own, say, VOO, VOO, the S&P, like, you're buying like an ETF that has like the 500 biggest companies in the US. Well, clearly there are non-US versions of these ETFs with different indexes. So one, for example, to look at might be the iShares Core MSCI Europe, which is essentially like a whole bunch of the biggest companies in Europe. And you've got other ones which are like non-US. So it might be like global equities, excluding US companies. There might be like country-specific ones or Eurozone-specific ones. But buying those ETFs would be a good way to give yourself Europe exposure in a well understood way. And again, good practice with buying ETFs is you really want them to be like passively managed, not actively managed, because most active managers underperform the market in the long run. And you want like the fees to be low as possible. And ideally, if they mirror like a well-defined index, then like that's a decent way into picking a good quality ETF. then
Right. And,
if you are an
yeah.
investor, like my fourth piece is, if you are an investor in individual companies and you want like euro income, then just go and buy like stocks in companies like ASML, which is, you know, a European listed company. It's denominated in euros. Don't buy the ADR, buy the actual like domestically listed version of the stock, which is what I've done with my ASML holding, and it's listed in euros and it pays dividends in
Can you explain
euros.
for our listeners what ADR means real fast?
American Depository Receipt. So an ADR is like the American version of the stock, which is I'm hand waving there because it's not really. It's like it doesn't even have to be like affiliated with the real company. It might be artificially created. There's different flavors of ADR. If you want to understand more about ADRs, I'll put a link to a article I wrote for Seven Investing a couple of years ago, which is still relevant on the ABCs of ADRs. I think I titled it.
It's kind of like a right. It's kind of like a derivative. So just like people say, you don't want to buy cryptocurrencies like on Robinhood because they're not actually really. You're just getting a paper that says you have a right to own the actual thing, but you don't really. In case things go belly up, you sometimes want to own the real thing. That's what Badger's telling us.
Yeah,
So,
and there is like there is talk. I think it's just rumor. I don't think it would happen that Trump might delist Chinese ADRs. So, like if I own BYD, I own the version of BYD that's listed on the Hong Kong Stock Exchange, but there is a BYD ADR. Like if that was delisted, I don't know what would happen if you owned that ADR. I don't know. Maybe you suddenly go to zero if you got caught with your pants down. I haven't got a clue. But yeah, like there's some risk, potentially some risk because of the geopolitical environment right now. Like I prefer not to use ADRs unless I have to. But anyway, to close out my little sort of 4 options to my friend who wants euro exposure, the last one is if you're comfortable investing in individual companies, just start buying some European listed equities, and ideally don't have to be dividend paying because if you own a non-dividend payer but it grows, your total wealth in euros is increasing and you can just sell a little bit if you want to release some euros. But if it pays an income and it actually pays out dividends, then you'll be receiving those dividends in euros with your brokerage as long as it supports like a euro kind of allocation in the account. So that's a way you could get like a euro income. Like if you literally wanted a couple of €1,000 a month as income, well, you could probably get that by buying probably like, a several £100,000 or dollars worth of European dividend paying stocks. And then that would give you your European income.
not a bad idea.
Yeah.
I'm at the moment just checking in on Badger's King of the Jungle portfolio, and I'm looking specifically at your investment in India. Because that's another called global diversification strategy, and I could see your return so far in that is 2.5%. So from where we bought it, some over a year ago, right? So
it was doing really well, up 30 or 40%, and it's just taken a hit in recent couple of months, and now I'm kind of back to my cost basis. I need to refresh my detail on why, but yeah.
So that's just another, I suppose, method is don't limit yourself to Europe when you have an investable country like India also on the platter.
Yeah, totally. Yeah, like I suppose you're asking this question for one of 2 reasons. One is like as an investor, and you just want like non-US exposure to be more diversified. But the other reason might be like a real life reason. Like I'm planning to move to Italy, Spain, Poland, wherever. And I want to kind of start preparing myself financially for that over the course of the next 10 years. So that might be a good reason to go for a particular country.
Yeah. Right on. All right. Well, Monkey's gonna look into tip number 2 for sure, and take a look at play around. I'll probably play around with WAS just as an initial step to create a couple more buckets of different currencies and see how they play out.
I sort of teed you up to like dive in and say just buy crypto if you want to like dollar protect yourself, but you didn't do it.
Yes. Why didn't I do that? Because I don't think it's necessarily. Uh, 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 hmm.
Probably just fed up me
First of all,
normalizing. Yeah.
yeah. I don't like using the word crypto, by the
Sure.
way, just because of the majority of those assets are not investable. Bitcoin could potentially be another one of these buckets, yes, and one that I participate in.
Yep. Very good. All right. So, somewhat by design, I'm about to buy a stock tomorrow, and somewhat by design, it exactly fits into that category we were just chatting about. It's a European dividend paying stock. So if you want euro exposure, maybe buy the stock I'm about to buy tomorrow. Should I tell you a little bit about that?
Yes, please. I'm surprised by this, actually.
Yeah, I thought you might be,
Yeah.
because it also ties into like our biotech conversation earlier, because it is kind of it's a pharma company anyway. Anyway, it's one I've talked about on podcast in recent weeks, but I've had on my radar for a few months. Novo Nordisk. So they're Danish, I think, and they're a big manufacturer of. They were originally like focused on diabetes medication. Then they, while developing like another diabetes medication some years ago, they essentially, like in one of their trials, they realized that like patients on this particular drug were having like significant weight loss, which they didn't expect. And that was kind of when the world discovered, probably going to mispronounce it, glutamide, which is, and then they branded it as Wegovy, which is their like breakthrough weight loss drug. That was one of the first weight loss drugs. And then they did really well as a consequence of that. So yeah, they kind of invented this category of GLP-1 agonists, these drugs, went on a crazy run, and now they've cratered. Their stock valuation has cratered in recent months, mostly because of competition from Eli Lilly, who have their own better competing set of weight loss drugs, and who also are about to release an oral weight loss drug, which is quite interesting because at the moment, all of these drugs you can buy are like injectables. So you have to like literally like jab yourself in the leg or something, I don't know, to take the drug every week or month. I've got no idea. But anyway, whenever you take it, you inject it. Eli Lilly have a pill form coming. And so obviously that's going to, like a whole bunch of people probably were put off taking those. So they didn't want to like have the injection. Well, that's going to open the market up to all these other folks who are probably sat on the sidelines, but want to use these drugs because in pill form it's much easier to take. And most people aren't scared of taking a pill. So that has really hurt the stock. But, and it's been on my watch list for some time, because it's a non-US, I want non-US exposure, and it's a dividend payer. Dividend yield is about 1.8%, might even be higher actually because of the stock price coming down recently. And it's also like it's not immune from tariffs. 2/3 of their revenue, like they manufacture in Europe, 2/3 of the revenue is them selling into North America, I guess, because probably you guys have like significant demand for weight loss drugs compared to Europe. So they have like massive exposure. And I think there are special pharmaceutical tariffs still yet to be announced. There's a whole bunch of uncertainty around this, but they seem to be very reasonably valued historically right now. And if I do like a simple reverse discounted cash flow on them, analysis on them, they're priced for about 14% free cash flow growth over the next 10 years using relatively conservative assumptions. And they've got some drugs in the pipeline, which I think are going to be quite interesting. And this is where I'm not going to go anywhere deep on this stuff because I do not understand it because I'm not a biotech guy. But essentially, Novo Nordisk have 4 obesity medications in their pipeline, 2 of which are at phase 3, so nearly ready to be released. And these are oral, like pill form anti-obesity drugs. I think one's called CagriSema and the other one is called oral sema obesity. And then evidently in trials, these have proven to be more effective than Eli Lilly's drugs. So if Eli Lilly have a lead right now, at least Novo Nordisk are going to come to parity in terms of the effectiveness, possibly exceed them. So I feel like we're probably at peak pessimism for this company, or at least nearing peak pessimism. So I'm going to take me a starter position in both my King of the Jungle portfolio and my real money portfolio.
I would need more time to dig through all of the facts and figures, Badger, but I'm actually a little pessimistic on this one.
That's fair. Yep.
Pessimistic might be too strong of a word. This obesity segment, I think there's going to be lots of winners, but Novo doesn't have the best numbers behind their offerings. So it still might be fine, but this to me feels like more of a like safe-ish harbor to place money where you don't know what else to do with. But given the market today, I'm not sure how I just don't feel tempted at all, because the decline in prices and the anchoring bias, and all that matters is future growth in the market. And if they don't have the best product, then maybe they're not just like cheap, but fairly valued rather than overvalued. And if they're fairly valued, then lots of companies, I suppose, I could make a case for as being fairly valued.
Yeah, I agree. So there's a few. Like most of the stuff in my portfolio today is overvalued. There's very little that's fairly valued. So, and there's not much on my radar I'm interested in that is fairly valued. So, and I do want to break the deliberate inertia and start buying again now, even though I feel like, and I've been public in saying, it's still a bit early to start buying stocks. I'm going to come off the sidelines and I'm going to start reinvesting my 25% cash. And so finding like a rare, fairly valued stock, I think is a reasonable place for someone like me to start buying again.
Yeah. Okay. That makes sense. I suppose all I'm saying is that I would not expect, terrific returns from this, but your mission is not to go for huge gains. It's to protect capital and employ it at least to fight inflation and cash.
Exactly. Yeah.
So that seems
like this is not one of your 10x stocks, and we do need to come back and look at your 10x portfolio soon. Maybe we can do that in the next couple of weeks. This ain't going to be like a 10x return. If this goes reasonably well and they continue to deliver, and if their new drugs that are in phase 3 hit the market and do start to recapture market share from Eli Lilly, this might be like a double over a multiple year time frame. But that's the kind of thing I like to have in my portfolio alongside the wild stuff. Right, indeed. I bought a put on something, but this has been a long episode. Maybe I should come back to that next week. I bought puts, i.e. I took I bet a certain company was going to go down. Maybe I'll talk about that next week.
Yeah. I think we've had a long conversation. So let's talk about you. Give us the update on your puts next week.
Yeah. Do you want to commit to doing your ASTS update next week? Because I'll be keen to get into that. And my puts somewhat relates to that.
Yeah, sure. Right. Well, this is my bandwidth is still extremely compressed right now, but it'll free up in the next couple of weeks. So if not next week, 2 weeks from now.
All right, great stuff. Oh, by the way, you might have noticed I use finchat.io for my Novo Nordisk analysis. Like I'm still using that tool every day. I've got 3 FinChat tabs open right now. It's a great tool for doing, as a long-term investor, it's a great tool for kind of understanding financials. And you can get a great discount if you go to finchat.io/wildlife.
Are you ready to become a beast of an investor?
Your journey starts here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.